Hey champ, it's Nicholas PURI here. Just like I said in my last video, don't adjust your screen, it's meant to be blank. We're going to be doing this based on a whiteboard today for this lesson. And the reason is that unfortunately our lighting equipment is bust at the moment, so we're waiting for our replacements to arrive, so we can't film anything apart from my screen. But that's okay because it kind of goes hand in hand with what we're going to talk about today. So, first of all, in the video I released earlier this week, it was about position sizing, and if you haven't already watched that, I suggest you go and watch that either now or at the end of this video. We'll make sure it's in the end card at the end of this video. But today what we're going to be talking about is exit strategy or exit criteria. Now, this is not going to talk about absolutely everything you need to know with your exit criteria because that's a detailed subject that's going to require more videos. What we're going to do is to go through the sort of basic underlying theory, the logic of it, so that you can then understand that when we refer back to it in the more complicated videos, which we'll come on to very soon. So this is the same way with the position sizing, that I covered that as just an overall concept, the theory, and then we'll go into more detail when we have actual examples. The same way we talked about uncertainty in the trades last week, which you haven't seen, you should also go and see that. And the other video was about trading the weakness in trends rather than the strength. So if you haven't watched those videos, go and check those ones out. All of these are going to make a lot more sense when I start showing my live account to you and we start talking through actual trade examples. So I don't have to explain everything every time. All of the lessons are there for you to understand. And also the 200 videos that we've already got on YouTube for free, they're all going to make more sense. So the thing about the exit strategy is that I think with anything in life, if you're going to start something, you need to have a clear idea of what you want to get out of it. And you also need to understand with things that are like projects or things that you're working on, what your exit strategy actually is for anything. It's like if you're going to a meeting at work, you need to know what you need to get out of it. If you're starting a company, you need to know why you're doing it, what you're trying to achieve, and also what your exit plan is for that company. Are you trying to sell the company? Are you trying to pass it on to someone else? What's your exit plan if things don't go well? And it's the same with trading as well. When you start learning how to trade, why are you doing it? What's your long-term vision? If things don't go well, what's your exit plan? Will you stop learning at some point? And of course, the same thing applies to the individual trades. So the same with everything. I think sometimes people neglect to see how trading is just a reflection of other aspects of life and other activities you do. And so you shouldn't ever be entering a trade without having a clear understanding of where you're going to be exiting. It's no good to say, I'm going to enter a trade at this point here, and I'm just going to see how far it goes on either side, because then on the downside, you end up with those situations where people hang around in trades forever until they finally come into a profit, and they end up losing a lot of money that way. And on the plus side, you never know when to exit, or you exit too soon or too late, because if you don't have a clear reason for why you're exiting, not only are you potentially leaving profit on the table that you could have taken, or potentially losing profit that you could have potentially made because you've given it back to the market, or on the other hand, you have a strategy that you can't test. The important thing for everything we do is that you've got something consistent that you can keep track of, so that if you need to optimize or see what part of your overall strategy, what part of your overall trading is going wrong, you can clearly try it. Like, you can test different variables. One variable is your exit strategy, and so that's what we're going to talk about. Now, in the same way with our position sizing video, we explained that there were, broadly speaking, 3 areas we wanted to look at. There was number 1, and I know this pen is going to be lagging just like it did yesterday. There's the setup. So that's the setup itself. What I mean is, when you enter, you have whatever criteria to actually enter the trade. That is your setup. With the Duomo method, we're always looking for double confirmation, but it's always based around a type 1 or type 2 close. That double confirmation with a type 1 and type 2 close, and whatever filters you're using in terms of indicators or triad of price action, that is the setup, okay? But your setup itself is within an overall structure in the market. So you can still enter a trade regardless of what the structure is in the market, but the structure determines, for one, it determines what position size you're using, and it also determines then your exit strategy. So by structure, we mean that, for example, and this is just broadly because obviously the context changes depending on different market movements. You never have 2 charts that are exactly the same, completely identical. But in an upwards trend, you, generally speaking, have waves like this, where you have the higher highs and you have higher lows taking place. So you can see this low is above this one, this high is above this one. That shows it's in uptrend. And the opposite is true when it's in downtrend, which is coming down like this. that you have lower highs and you have lower lows over here. So that's the uptrend and the downtrend structure, broadly speaking. You also then have a ranging market, which is broadly speaking like this, like a sideways market, where your highs and lows are very similar shapes. So you can be in these structures, and depending on where your position is in the structure and what the setup is there, you'll have different sort of overall context for what's going on. So for example, you might be going short and you might be at a lower high, as in you have all of that space of the potential new wave to go, or you could be right here and you know that there's going to be a move potentially against you before it comes down. The opposite is true over here, or in the range you could be at this point in a range going short, in which case you've got all of this, or you could be at this point in the range going short, in which case you've only got this distance here. Okay, so the structure matters a lot. It doesn't, I mean, you can't predict the future based on this. You can't say just because you're here, you know that it's going to go this way, because at this point in time, you don't know if the market's going to go up like this against you. But it's just from understanding the overall structure, the overall context, helps you understand more or less like where the market wants to go if it's in a downtrend, or wants to go if it's in an uptrend, and therefore where you are positioned against that. And the third thing that we spoke about yesterday was the path of resistance. And that's because, like a lot of things in life, in the world, the price wants to move in the path of least resistance, which means if there's a path of resistance, the chances are the price is not going to be moving in that direction. Now, what creates a path of resistance in our method are significant levels. We call them significant levels, and that's what we're using our tools to identify in the market. Now, a significant level isn't a magical level on the chart. It's actually created by market orders and activity that goes on in those areas for whatever reason. And our tools help us identify them. And the tools, the significant levels, are basically obstacles in the market. The reason that we trade one down here, for example, is because we realize that, you know, if the market's closing on that level, it's showing its significance, we know that the path of resistance is now this way, and therefore we can go long that way, thinking that the price is going to be moving through the path of least resistance. And this is why we talk about trading the weakness in the trend. If a trend's coming down this way and it's showing weakness at that point, and we know the path of resistance is there, we can now bet that it's going to be moving against that in the path of least resistance. So the same is true with the exit strategy. If you've gone long there, and now your path of resistance is this way, whatever it is that's over there, then once it gets over here, you can tell that you're about to enter a path of resistance. If you have other factors that are telling you to exit, that may be the time. So those are, broadly speaking, the three factors that we look at. Now, we're going to rush through this because, like I said, we could go into each of these in detail and it will cover like a whole hour or something in a video on its own. And I just want to get through the overall concepts that when I refer back to this in the future, you understand what I'm talking about. But basically, when you enter your trade, you want to be assessing these 3 points to not only determine when to exit the trade, but when to for profit, but when to exit the trade at a loss as well, so where your stop loss will be. Now, when you're deciding whether it's a viable trade, you have something called a TMP. This is your trade move potential. This is a conservative estimate based on these 3 points of where the trade's likely to go. And when I say conservative, I mean worst case scenario in profit. So your stop loss is conservative as your worst case scenario in loss, because basically it's saying if the trade goes against you rather than going in profit, at what point are you going to decide enough's enough and I'm going to exit the trade? And you don't do that based on how much you can stomach, whether you're risk averse or not. You should be basing that on the setup of the market, the overall context, which is these 3 points. And so the same for the TMP. Now the thing about the TMP is that, let's say that you're entering down here on this uptrend, right? And let's say that the market has, I don't know, it's come down like this before this point. Now, your TMP is your conservative estimate. However, at this point in time, you have no idea what the price is going to do next. So all you can do is base it on what's happened in the past. But of course, just because something's happened in the past doesn't mean it's going to happen again in the future. So let's say that you've been in a downtrend because you're getting lower highs, lower lows in this sort of movement down. You've got your setup here. So you've got your entry. You know that the path of resistance is against you this way. So it's on your side basically, because the price isn't going to want to move here. It's going to want to move upwards. you might say that based on the structure of the market, then beyond this point here, looking at this area here, beyond that point, you've created a higher high, because these are lower highs. If you go above that point and create a wave, you've now created a higher high, which means that now structure's on your side, setup is on your side, because that's the whole reason you entered. You got your double confirmation or whatever, and the path resistance is on your side, because that's another reason that you entered over here. You had these lines here, whatever it is, the activity that's caused this sort of move up from this trend down. So this is your TMP conservative. The reason I say it's worst case is because ideally we want that to be sort of creating a higher high and continuing upwards. But if it doesn't, if it comes over here and fails, you get like a type 1 or type 2 close and you realize that the path resistance is against you there and it's coming down this way, this is the point where the structure is potentially not going to be on your side. If it fails to create a higher high, it's not going to be on your side. So that's the very first thing we can use on the chart as saying, okay, worst case scenario, we reach this point, it fails to break a new high, and therefore we're going to exit. So that's going to be our trade move potential. And the reason that we need that, and the reason we use that as a conservative estimate, is because that's how we're going to assess the trade. Some people assess trades and say, if this trade goes well, I can have 1,000 pips and I'll get the reversal of the entire year. It's going to, completely crash and all this kind of stuff. That's not the way to do it. Of course, once you're in the trade, that's what you hope is going to happen. But in order to keep your risk measures in check, to make sure you're conservative, you're doing things correctly, then you want to be worst case. You say, okay, when I've entered, maybe that's my TMP over here. My exit based on, if, for example, this breaks again, if we enter here and it breaks against us and it starts to create another lower low, so it goes below this point, then I'm going to be out of the trade because the downtrend's still continuing. And I've broken the setup, so I'm in setup break, which we'll explain in detail another time. We're now structure against us, so setup is against us at that point, structure is against us at that point, and the path resistance is likely to be against us because whatever significant level you entered on, since the significant levels have no directional bias, is going to be against you. So the chances are that's against you as well. So that's why you're going to exit at that point. Now, your exit is set in stone. You don't change that. The reason is because any fluctuations below that is going to be further against you. So on the upside, where your TMP is, any fluctuations beyond that TMP point are going to be in your favor. The price is going to be moving up. But with this stop loss, if the fluctuations are above that stop loss, that's fine. It hasn't yet broken a structure, hasn't yet broken a setup and all that kind of thing, and the path resistance is still in your favor, so you wouldn't want to exit. But below that point, you're in limbo. Suddenly, everything's against you. You should be out of that trade. Doesn't mean you can't find a re-entry at another point, but you should be exiting and taking the loss. Okay, it's not a bad thing to take a loss. I'd rather take losses in order to get gains. Some of the best traders of all time have losing success rates. So they're below 50% their success rate of the trades. And the reason is because you can take small losses in order to get that one big trade that's going to carry you to having a lot more profit. It's logical. You exit when things are uncertain and you stay in your trades when things are more certain, right? And in profit. That's called cutting your losers short and hanging on to your winners. So your TMP, you put your sort of, let's say that this is your TMP on this chart here. However, when it reaches that point, I'm not going to exit that trade until I actually see that the criteria for exiting a trade have been met. So that's just for assessing the viability of the trade. So I've decided, okay, based on my TMP, based on the worst case scenario, this trade is worth going for based on the risk rewards, the overall success rate. I've decided my position size and now I enter the trade and it reaches this point here. However, the momentum's on my side, the overall structure in the market, like it's looking like it's going to break this level, or it does break the level, it doesn't fail there or anything. So there's no point having an order, like to have a take profit order in the market at that point to exit the trade there. There's just no point. You might as well wait and do it manually. So you're in profit by this point. Suddenly, it looks like it's breaking to the upside. So what happens? It creates the higher high. Now at this point, you have market structure on your side. You have the setup still on your side because it's created the setup and the path resistance down this way. Now, at this point, you have a couple of different options that, yes, you could potentially exit the trade, but you could also hang into the trade. So let's discuss very briefly. So why would you potentially exit the trade here? you have to look back to the criteria. So path resistance. Obviously, there's a path resistance at this point because it's stalling for whatever reason and coming back down this way. So if that path resistance is combined with a setup, in other words, you've just had a type 1 and type 2 or type 2 close on a double confirmation, maybe major level over here, you'd probably think, okay, I've got the path resistance against me, the setup's against me, the structure is maybe, I don't know if it's going to be in my favor or not. At the moment, it is a little bit. I'm going to exit. Okay, so the same reason that you would have entered a trade, you're going to exit because you're getting the criteria for entering short. So you would rather exit your trade at that point. However, let's say there's obviously the path resistance over here, but there is no setup. So there is no type 1 or type 2 on a major significant level. There's no double confirmation to go short at that point. So you think, okay, there's no setup. So setup still on my side. The structure in the market is on my side, but it's uncertain what's going to happen next. But I'll wait to see what happens to that. The path resistance is the thing that's against me. Okay, so 2 out of 3. Okay, let's stay in the trade. And at this point, what you're wanting to see is, of course, it's going to create a new low. But first of all, you want to see, is it going to create a higher low or a lower low? So yes, you can keep your stop loss where it is, or you can move it up to break even at that point, because beyond that point, on a closing basis, there's going to be a lower low, and that means that the structure is maybe broken down, and that means uncertainty. So instead, we want to play it out. So we leave our stop loss there. At this point, it's created the higher lows, we've stayed in the trade, and here we are breaking upwards. Now, at each of these different points, we're assessing the same thing. We're waiting for the structure to be against us, or two of these three things. We know that whenever it's stalling, so whenever, you know, that it looks like the wave is completing at this point, we know that the path resistance is against us. That's why that's happening. So that's already one thing. But then you want to assess either, is it that the setup is happening there, that you would enter short at that point? If not, is the structure against you? And the structure is only going to be against you when you're getting the sort of lower lows and lower highs against what direction you're trying to go in. So if you're trying to go upwards, you want higher highs, higher lows. Once you start getting lower highs, lower lows, that's when you want to exit. Unless you get the setup, then that's the end, like a setup double confirmation on a significant level. That would be an entry short. So at the same time, you want to be exiting. So I know this is a quick run through, but we're going to be coming back to this and referring back to it in other videos. So I just wanted to go through it now so that you understood what I'm talking about when I say like setup, structure, path, resistance. These are important things in the market. I want you to understand that your TMP is not necessarily the same as where you actually enter your trade. It's just based on, you know, it's the worst case scenario so that you can assess if it's viable even in the worst case. And essentially by taking this approach, you could stay in trades indefinitely. Right? So the other reason that you might exit a trade is when there's news being released. So the same way we talked about with our position size, that there's different news that can affect your trade. You need to assess whether it's worth exiting your trade or whether you can hang in it and just be cautious. So for example, if you first entered your trade and it's still here and it's still like not in too much profit, you might, if there's news coming out just and it's, you know, news that's related to the market you're trading, exit your trade straight away. However, if you've gone up here and you're in the middle of the structure and you've made some profit and it's on your side, you might want to wait for the news release to happen, as long as it's a minor one, and just wait for the structure to break still. So maybe put your stop loss here, and when the price goes there, if it does, then you exit at that point, when it's going to create a lower low. However, if it's things like NFP and, you know, GDP and bigger news releases, you want to be out of it completely, because the movement from here, where it's in your favor, to down here can be a split second, and then you're in a loss. And once the structure is on your side, so you've had your setup with path resistance, once the structure's on your side, so you've created, say, higher highs, higher lows when you've entered long, then at that point you should never ever let a trade become a losing trade. That should be one of your rules. You should never let it become a losing trade, because that means you've allowed it to go from a favorable structure to an unfavorable structure and a loss. So you haven't picked up the signs. Now, based on all of this, you can start to pick up signs instantly after your entry about things like the path resistance, whether the setup's in your favor, and if the structure's already against you, then you already know that one. And these are the kind of contextual type approaches that I want to go through in future videos. So it's sort of like when people are training to become like a chess grandmaster, they're not necessarily playing chess all the time. Sometimes when you get to a certain level, you go through scenarios and figure out backwards what you should do in that situation to get the favourable outcome. And that's kind of what I want us to go through, that you end up developing in your mind this playbook, like American football players when they have certain plays that they can do in certain situations, or basketball players and that kind of thing. Like, this is what I want us to have as a playbook in our mind in certain scenarios, what you should be doing, the approach you should take. I know it seems very rigid and structured with the different rules we have, especially with the position size one, but it's something that becomes fluid. It's just I'm trying to get the decision-making process out of my mind and put it in a way that you will be able to relate to in a structured format, that you can then take that and then add your own creative freedom with it and trade with it your way. So anyway, if you like this video, then please do leave a thumbs up, because I like to know which videos you prefer. If you have any questions, comments, complaints, suggestions, anything else, leave it below. And if you want more videos about learning to trade, don't forget to subscribe to the channel. The button will be over here somewhere. It'll be like a little circle thing, so click that, subscribe, and I'll see you in the next video very, very soon. Thanks a lot for watching, guys. Take care. Bye-bye.